All right, everyone. Welcome back to another episode of Bell Curve. Before we jump in, quick disclaimer. The views expressed by my co-host today are their personal views, and they do not represent the views of any organization with which the co-hosts are associated with. Nothing in the episode is construed or relied upon as financial, technical, tax, legal, or other advice. You know the deal. Now, let's jump into the episode.
All right, everyone. Welcome back to another roundup edition of Bell Curve. We got Michael's 1 and 2, Vance and Yano.
We got Happy Mike now.
Yeah, let's go. This is the radio voice. This is the face, the smile. Let's go. How are we doing, guys? You guys recovered from permissionless?
No more conferences for a little bit. I think I'm off the conference tour. I'm here in New York. I don't know if I'm going to go to mainnet, maybe just the dinners and stuff. But I thought permissionless was great.
It's a cool city. There's honestly, the South is just, as someone who grew up in the North, the South gets something that the North doesn't get. They're much more laid back. They're like just more chilled and ready for good times.
I don't know if Austin is the South, but
I mean, it
I like
kind of
where
is
you're
though.
going with this.
I was in Nashville once, and I was like, I said basically something like what I just said, like, oh, the South there's something really cool about the South. It's like I went to school in the South in Atlanta, and this guy's like, Atlanta is the New York of the South. I was like, oh shit. All right. Well, never mind then.
Really get there.
Let's start talking about crypto stuff. I would be curious. I kind of want to start by talking about Eclipse. So Eclipse, Neil Samani, the founder, spoke at Permissionless. And he's got a company called Eclipse. They were an SVM based roll up as a service product that announced this week that they were launching a roll up on Ethereum. So what's particularly interesting about Neil's design choice for Eclipse is that it uses the Solana virtual machine. And there's a bunch of advantages that the SVM has over the EVM, excluding network effect, where the EVM is definitely winning. The major reason why you'd want to use the SVM is parallel runtime. So local fee markets, parallel execution is built right into that. The EVM has a single thread processor, which just limits its scale, whereas the SVM can do parallel execution. They're also using Celestia for data availability. So they're not using ETH Validator set for DA, and they're using RISC-0 for proofs. So in a sense, you could bill it as sort of a best of all worlds situation where you have very fast execution, really cheap DA, and it still settles down to ETH. And I think they're going to use ETH as the gas token as well. So it's kind of a very interesting blend of a whole bunch of different ecosystems. I'd be curious what you guys thought about this.
It's kind of the opposite of Neon, right? Which was bringing the EVM to Solana. That was very hyped up because it was like, the EVM has network effects, Solidity has lots of developers on it.
Well, I think they're using Neon here.
They're using Neon here.
Yeah, they're using Neon for EVM compatibility. So if you want to easily deploy EVM smart contracts on Eclipse, you can do it through Neon. It's cool. So it's not just DA, so it's DA and Celestia, like Mike mentioned, SVM for execution, settlement on Ethereum, ETH is the gas token, and then proving is using RISC-0 for ZK proofs, and then EVM compatibility via Neon EVM. It's like the first time I've ever seen like the full modular, not just on like DA and execution and stuff, but like bringing all these different providers together.
I think it's probably not as relevant for DeFi. I think it's most relevant for games where like local fee markets actually matter, because one game clogs Polygon proof of stake. Like there needs to be some other scaling solution than just launching all these games on a single threaded chain. So I think this is it's interesting from a technical perspective. I think the ramifications will play out when there's like all these games clogging all these different L2s. Like there will 100% be that. And I honestly do think like the parallelized version of scaling blockchains makes sense for high density, high throughput markets like gaming. So I think it's pretty interesting.
Like, what do you think about this? You called this early.
No, I just think Michael and I actually talked about this when it was just the two of us, but I think the way you could, like, the problem that most blockchains are running into is one of scale. And there's a couple of different, so like ETH main chain runs into this problem where Ethereum, the network, is optimized for solo validators that have very low hardware requirements. So there's just limited throughput that you can do on main chain. And one of the big problems with ETH, and specifically the way that they allocate resources, is that all the resources are sort of coupled. So one, there's just not very high throughput on ETH main chain. But then two, the way gas fees are calculated is there are two inputs. It's the base fee, and then there's the computational resources that each transaction requires. So what you can get is if there's like a really hot NFT mint, it can multiply the base fee, and then that base fee gets applied to transactions on Uniswap. So the resources are coupled in a way that doesn't really make sense. So what Solana, it's like there's a couple ways that you could solve that, which is one, to just put every single blockchain application on its own chain, which is sort of the ETH rollup. Like that's the OP stack version of how to solve this problem. The other way that you could solve it is to actually keep everything on one settlement layer and chain, but do what Solana did by creating local fee markets and parallel processing. And I don't know, I think a big question for me is how much 4844 and dank sharding is actually going to reduce the costs of these rollups. And the way I've been thinking about it recently is that it's not going to reduce costs that much, especially on the canonical rollups that still use DA or Ethereum for data availability. So I think you need one of these rollups to try something like the solution that that Eclipse is pioneering here. And actually, I'm starting to get a little bearish on just how many app specific rollups do you really need? You know, I kind of starting to get a little bearish on that idea. So I think what Neil has done is very clever in terms of the design. And then it's going to be down to his BD chops to actually go and recruit developers. And who he's probably competing with for devs is Solana, because these are Rust devs, I think, that he's hoping to bring over and build applications. So I think it's really, I really like the architecture. But yeah, that's what I think about it.
I wonder what, like on an average day, this is, paying to ETH to settle if it's not paying for DA. Like, do you have a sense of that?
Dude, it's nothing. It's like $100 a day or something like that, on the order of $100 a day. Yeah. Yeah. It's when as soon as you accept a modular roadmap, what you don't know, what nobody knows, and everyone's guessing at right now, is where the network effects are. Like what layer the network effects accrue to. And maybe because we started this whole industry in Bitcoin, like the settlement layer, like how many times have you heard that settlement? It's all about that. I don't know, but it could not be settlement, right? Like you could imagine, like whether you know it or not, your base view has probably been very oriented around, well, you provide a lot of security at the base layer, make really good settlement assurances, and then everyone's going to have to come to you, and there's going to be this bottleneck of supply and demand where you could totally flip your framing and say, actually, all of the stickiness is going to accrue at the execution layer. And there's just going to be these interchangeable parts that you can swap in and out at the base layer. And it's probably not going to be as simple as one of those framings, but I think projects like Neil's is going to make people question some of their assumptions about where value actually ends up accruing. That's what I think.
Not to say that this will play out in the same way, but it does kind of remind me of what like the mid 2010s whole SaaS business model was, which was basically just like wrappers on top of AWS or GCP. And it was all, this narrative of, oh, well, it's going to be Dropbox, and Dropbox owns the customer relationship, and Dropbox, is what people think about. But in reality, it's just this cloud storage built on top of S3, EC2. And, we've talked about this as well, Mike, but the value ultimately still accrued to AWS. It's just because, everybody thought, oh, well, we'll just go off and build our own. We'll have our own. It's going to be better that way. It'll be cheaper that way. But in reality, it's cheaper to have AWS because they have economies of scale. So I kind of wonder if settlement will become the same thing. The narrative of we don't need to do anybody else's settlement is becoming more pronounced. But I think ultimately people are going to realize it's better just to have the same security. And even if it is the cheapest way, like it's better to rely on somebody else for handling that.
Yeah. I still don't think, though, even if everyone uses ETH for settlement, that's necessarily bullish. Not that this is necessarily what we're talking about, but ETH token price. I don't know if that means that value has to accrue to ETH the token. So Celestia is launching soon. So Eclipse is using Celestia. Eclipse hasn't launched their mainnet yet. They're going to use Celestia. So I'd guess that Celestia is going to launch before Eclipse launches their mainnet. So is that not that this is the not financial advice section, but what does this mean for ETH price and just the demand for ETH if all of these rollups start using Celestia for data availability? Like, how do you guys think about that?
So I think there's, not financial advice, no price predictions, all of those caveats. I think there's two elements to a token's price in my mind. One is the fees, the underlying, and the other is the monetary premium. And the only two assets that have monetary premium are basically ETH and Bitcoin, in my mind at least. And by entering that category, you enter into a more expansive valuation, heuristic. Like, what is gold worth? People just say it's worth what it's worth because it's been worth that for thousands of years. And so, like, if you think an ETH and Bitcoin have that lendiness, the market is pretty sufficiently large as long as it's used as money. And where does it get its money use case from? Like, Eclipse is using ETH as the gas token. Like, we've talked about this a little bit. It's like, is that ETH burnt when it crosses the bridge? People just came out of the woodwork when I tweeted that. I don't think it's entirely that way, but I do think there is some element of putting it on a chain as a use case that looks and feels like money. And then you have the DeFi and the NFTs and the games that live on ETH L1. And that's kind of where the fees come from. I do think the other part of this is if we already have, like, I don't even know how many rollups we have, 200 at this point, like more than 100 for sure, at least in production. Like, if we are underestimating the amount of rollups by like 2 orders of magnitude, maybe that is enough, just to add more incremental fees and build that story. But at some level, like the valuation heuristics of an ETH token price are more determined by how much of it is used, as money versus the fees. That's at least what I think. Like when you, like, all the friend tech keys are priced in ETH. Like, when you see ETH bridging to new L2s, like, that money's there to speculate. Like, it's a very unique asset. It's impossible to value on just fundamentals alone.
And it's also highly possible, once again, not financial advice, that we see a J curve in terms of how much of the fundamentals or which direction the fundamentals go. And I have been doing a little bit of research on what this new 4844 will do to the economics. And there's going to be 3 blob spaces per block, which means that there's going to be 3 rollups that can put their blobs in a block. And if we already have 100 rollups, think about what that's going to do. Like, how often is your rollup going to go settle back to ETH L1? Is it going to be once every 10 minutes? Is it going to be once every 10 blocks? Like, who knows, right? There's only 3 spots. And I would imagine that we're still going to see the continuation of, roll apps. We're not going to stop at 100. Who knows where we end up maxing out in terms of the number of rollups, but I think there's not going to be that much available space for roll apps to be able to deploy onto ETH L1. And so, I don't know. I mean, it may go down in the meantime in terms of the amount of transaction volume or transaction fees, but I would say, directionally it's going up.
If you think about the high level, Mike, like, I totally am sympathetic to your argument, but like, if I look at what happened on chain today, like, Binance spiked it to like 100 Gwei because they were using some inefficient script to move, assets off of their exchange. Like, the scaling problem is fixed and fees are like, low until fees are like incredibly high. Like, in my view, the validator business is big lumpy days. That's really what you want, right? And so, like, sure, if you think about like what the yields on ETH could be, let's say that, ETH doubles in terms of staked and what you're earning as a yield, you're probably earning, low 3s most of the time in terms of yield. But whenever there's like even a smidgen of activity, like, you're back in the 6-7% range. And it's kind of hard to pinpoint when exactly that happens, but it's just when basically the market turns back on. So it's levered to the cycle effectively. Yields are always going to be lower in bear markets. The other thing that I think is really kind of like central to this question is what role does restaked ETH play? Because that's like another money-like use case where it's like, sure, the fees on ETH, most of the time are like, say you net out on average, like, in the 4s. Like, you can augment that with basically ETH-centric yield farms where you're taking your ETH and going off and validating other, DAs, other bridges, other oracles. Like, that is a very bizarre use case that you can't quantify in a financial model, but it adds the monetary premium.
I agree with that. I think it's I have a couple of thoughts on that. So one, just a note about that 3 blobs per slot. That actually isn't limited to rollups. So the market for blob space is a permissionless market. So you could have an NFT project mint using blob space. So it's even slightly more constrained than 3 rollups per slot.
Do you remember in the bull market when it was like $3,000 to see?
Yeah.
Like I think that's going to come back, but I think it's going to be like you look at the biggest fee days and you can see them on a chart for ETH. They're like 100 times, the next closest days. That's kind of
So you think some of those days come back? Like when was one of those days? What's an example? Like the Bored Ape
the
Mint,
Bored Ape Mint.
for example.
I mean,
Yeah.
like people forget, but all of those NFT mints were like sold out. Gas War, Goomba Fair, like all of the ICOs, same thing. Everyone racing to hit that one endpoint, and like that's like the essence of why Ethereum block space is actually differentiated. It's because that stuff happens on it and it's viewed as this like high touch, high class, high gloss block space. So that only manifests in terms of, super high fee markets every once in a while, but I'm not as bearish on the fee outlook as most people. I think you're still going to be in the fours when it comes down to like you clock out a year, what did you actually make? That would be my guess.
I mean, I think it was November or maybe it was October last year. There were like 4 or 5 days straight of really high fees, and that jumped the yield to like 8, 9, 10%. And that was post merge. That was the highest yield I think we've had in terms of a week. But that was pushing double digits, and that was 2022.
Let's talk about the converse of this argument, which is kind of the argument for L2.
There's some concept, right, of like a Laffer curve,
right? Yeah.
Which is where there's like you're actually missing out on some amount of transactions here. It's like dead weight load or something like that, where when fees spiked to that degree, there's a lot of people that are just priced out of making transactions at all, right? So there's like, if you use the example of like Solana maybe being way like too cheap relative to the use cases that we need today versus every trade costs $1 million, right? Like obviously if every trade costs that much, no one makes a transaction. There's some sweet spot where actually it's all very optimized in terms of the maximizing the amount of people that are making transactions than actually fees that get paid back. So it's kind of like what Multicoin talks about, like the reverse network effects, right? Of the fee market on Ethereum.
I think that's right. And like if you do the math, basically what you come up with is that if your transactions are sub 1 cent, you need 100 million of them per day to make 20 to 30 million sequencer profit per year. And so like the strategy of teams being like, we're going to drive block space cost to zero. It's like, that is a strategy. You can definitely differentiate yourself, I guess now less than you used to be able to, but like that is actually a shit business model where how do you get 100 million transactions on chain? You're building something that probably more looks like Arweave or like Filecoin or like, you're trying to put high volume, high quantity data on chain. I don't know if that's necessarily where you want to be. If you're trying to bootstrap, a native asset as something other than just like pseudo equity.
Because frankly, we haven't seen an application that has that much throughput on chain.
Right.
Ever.
No, I mean, I think there will be some, but if 100 million transactions per day is the bar for 20 to 30 million in profit, that's a tough business model. I also think it's better to start with more expensive block space and then work your way down. Why is that a better strategy? Because you are signaling the high quality, the high gloss, like Bitcoin, ETH, like a lot of the early days of that were just like, it's so inefficient, but the demand was overwhelming compared to the supply. And then over time, you kind of just drive supply of block space higher. And you're able to kind of smooth out that transition. And so like, that's like you have to take like the 10 to 20 year view of these things. If you're going to ask the questions of like, where are fees going to accrue? Where is value going to accrue? It's going to be interesting. The other thing I'll say is that I do think that there's going to be this weird catch-up effect of dank sharding kind of taking over some of the scalability load from these L2s right as they're in their own kind of process of figuring out how do you get to that 100 million transactions per day. So it's going to be different, for even the L2s. It's not, I don't think the L2s have clearly run away with the market compared to the L1s. They're just at a different point in their scaling roadmap.
I don't disagree with like anything that you're saying either. I'm trying to game out what I've been recently thinking about is what is going to happen when the bull market ends up returning. Like, how are things going to play out? And I think there's like one scenario where I think so activity starts coming back, gas fees start going up, and then people are like, that's okay, we have roll-ups. But I don't think 4844 is going to solve the fees on for most rollups because you're still paying DA to Ethereum. So there's a lot of burn going on. The fees are high, yields are going up for stakers, profit is being returned. That's good for the network.
Mm-hmm.
But I think at some point, this is where Solana and some of the other like alt L1s won last time, right? Everyone's like, this is crazy. We haven't solved the fee thing. And then people start looking for cheaper alternatives. And at this point in the cycle, no one really cares about security, right? Like everyone does kind of dumb stuff. And that's where I think somewhere like either Eclipse, which uses the SVM, and Celestia for DA starts winning, or Solana starts winning. The other version of the future that could work as well is if we just change the definition of what constitutes a canonical rollup. And the Dankrat argument is kind of like people don't care about. And they're like, you know what? DA is actually not part of being a rollup. You don't have to use ETH DA. And like, we can just use EigenDA or Veil or Celestia or whatever. And then I think the fees will go down drastically on rollups, and then ETH and the rollup landscape will do a lot better. But that's what I'm kind of trying to think out right now, is where like who ends up winning and who ends up getting a bunch of their new users from this next cycle.
The lived experience of developers on the ground is like, you launched on a super chain, you launched on a fucking ghost island. Like nobody's there. Like you are like, it really is not a technology first argument. Like I'm pretty sure you could build a centralized blockchain, roll up, Validium, whatever, and actually get your blockchain cost to zero. I don't know how much good that would do you if the main benefits of crypto are composability, community, open source, permissionlessness. And so like it isn't always a strictly technical argument. I do agree with you on the narrative of fees are going to go up. People are going to be like, oh my God, fees are like 5, 6, 7, 8% again, crazy NFT mints, crazy games, whatever. Like literally the stuff that was driving the fee spike in first quarter was like this one XNet like Ponzi thing. Like it was like this single weird Chinese app that had no sensitivity to gas prices. Like it's as simple as that. And you have a couple of those, 3 of those, 4 of those sentiment turns, like fees are going to go back up. The question is like when that stops activity out, because there was a point where it was just like, I can't introduce anybody to ETH because it literally is so expensive to onboard them. Like it just doesn't make sense. I don't think we're going to get there again because that load will probably be handled by rollups. But I do think the games are going to break the rollups if they really take off. And that's kind of where the question is going to be like, how much of this should we put on chain? What other modular architecture can drive our costs down? That type of stuff.
I think one of the variables that I was thinking about recently is at what price point does it become beneficial to have basically the application pay the gas fees on behalf of the consumer? And I think that will be a flipping point when it's so cheap that, okay, great, we'll just bake this into our cost of goods sold. We'll bake this into something that's abstracted away for the user, account abstraction, that's great. The wallet will handle it, the app will handle it, what have you. And so I think ultimately you're going to get to a point where it becomes so cheap that you actually don't have to pay anything anymore. And it's not because no one's paying, it's just because the user is now not having to pay.
People love to talk about the burn. The burn does not, in our opinion, drive ETH prices. There is no price impact from that, except on like the super long indeterminate time period where it's like, Apple took like a quarter of their shares out of the market compared to the past 10 years. Like maybe that on the margin drives some of the action, but the thing that drives action is demand. Like even in this current market, kind of what I see at least is there are not a lot of sellers, but there's not a lot of buyers. But when the buyers show up, like you saw that huge volatile round trip that BTC and ETH took, over 27 into like the high 1600s, like that's kind of what happens. And so what can drive demand for that? That's That's the name brand recognition of Ethereum being the gas token on every chain. It's the ability for ETH to be composable into restaking, to be used in DeFi. Like, unless another asset becomes that, I don't see the same level of like bull case for it.
The 1559 also, I mean, the reason it kind of got co-opted by this ultrasound money meme and like the burn, and people like to talk about, and they think it's a supply-based argument. But my understanding of why the burn got implemented is because Ethereum as a protocol doesn't want to have to make a choice about where there's like security reasons for not wanting to, like, the burn is actually more about a security and anti-collusion thing for validators than it is about like number go up technology. And it actually, if you look at how it's done in Cosmos, it's extremely different. A lot of the fees that the protocol or the Cosmos hub makes is kind of like redirected via the hub, which is, that's like not very money like, so I hear you on that, and I think that is a big part of ETH's value prop is, it's a ETH could become a denomination.
It already has, and finding something product market fit for something as money is the hardest thing to do of anything. It requires people to actually own it, think of it as money, think of it as a store of value, use it in credit, use it to pay for things. Like, that is a decade-long process that involves going 100x up and 99% down multiple times and having people hold on with you. And so, like, it's I don't think you can make something money if you tried. It just kind of happens.
I don't know. This is where I do think, like, I think crypto's net new, and people would really object to, is it a money or is it a commodity? Because that would inherently put it in some bucket that you have in your mind, and therefore the valuation heuristic would be changed. But I just think crypto's a net new thing, actually. And to call it a money, it's like, if there are money-like properties, there are also, frankly, commodity-like properties of this thing too. Like is oil money? In a sense, oil's the realest money that there is, right? It's the input for everything in society. Arthur Hayes wrote a whole blog post about how you should denominate your life in oil, but that doesn't mean you could go to the store and use money and pay for something in oil.
Classic Arthur. Yeah.
But in a sense, oil is
Yeah.
a much more real form of money than paper dollars that the government prints. So I don't know. I hear that. I would object to maybe like explicitly being like, it's a money and this is how we're going to think exactly one-to-one on ETH, but it is a store of value, money commodity like thing. And I agree that that's super valuable.
Vance and I denominate our net worth in ETH, so that's how we live.
Oh yeah.
Well, Mike and I do it in oil, so.
Yeah, right, exactly. Looking at crude go up, baby. Vance, you said one other thing that I think is really interesting, which is the role that EigenLayer is going to have to play in that, which there's like a money-like role, but then there's also a yield role, which EigenLayer is going to have to play. So I think Shriram has come under a little bit of fire from the ETH Foundation, who restaking is kind of a scary idea. It's sort of rehypothecating ETH. Shriram would object to this, but like my personal opinion, it looks a lot like adding leverage to the system. You're adding multiple claims on the same asset, but I think a narrative shift is actually coming for EigenLayer, where people view it as something that's very pro solo stakers and that will enable solo stakers to keep their yield up. And there's a piece that Dankrad wrote recently, which is where he talks about EigenLayer like this, which is seeing if restaking, like the long-term solution. Ethereum's dealing with a problem right now that they actually have too many validators, and it's difficult to attest to and confirm transactions in a timely way. So there's like a whole bunch of different solutions being proposed. But one of the things that people are starting to be nervous about is exactly what you said, Vance, which is after a certain percentage of the ETH supply is staked, then yields will go down to a point where it's just not very competitive. And restaking could be an answer there that could supplement the yield that people are losing on a higher stake rate. And that could be framed as a positive solo staker thing.
Why is EigenLayer bad for solo stakers? Solo stakers can participate in EigenLayer, right? By
It's not bad for solo stakers. It's a threat to the whole network in a sense. If you kind of think about a worst case scenario, and there are multiple operational models for EigenLayer. So you could, like, the most intensive model for EigenLayer as a solo staker is you could opt into running additional hardware yourself. So you could turn over your withdrawal keys to the EigenLayer network, and then you could actually run in like a future state a decentralized sequencer on Optimism if they ever go that route. The other thing that you can do that's going to be probably the dominant way that people actually use EigenLayer is you liquid stake, and then you delegate your liquid stake to someone else who is running hardware on your behalf. So EigenLayer isn't really pro or anti solo staker in a sense. It will enable solo stakers to earn more yield, but if it depends on the model that you use EigenLayer. If you like liquid stake and then just delegate your liquid stake into the EigenLayer network and someone runs hardware on your behalf, you're just accepting a higher amount of principal agent risk. Like there's just more layers.
Because you're at risk of slashing for the restaker. So you have to basically
For
trust
both.
that.
For both. It's like,
Yeah.
think about your counterparty. So if you liquid stake with Lido, your counterparty is the staking pool. It's Lido. And then once you get the liquid staking token, and then you delegate that into the EigenLayer network, and they pair it up with someone who's running like a sequencer or an oracle or something like that, then you're trusting the EigenLayer network and whoever's actually running that hardware on your behalf. You're just adding layers of principal agent problem. It's just someone who's supposed to be acting on your behalf, but could screw you.
Someone will get blown up by this at some point. Trying to pick up that extra 2% yield, and they get slashed or something catastrophic happens. So 2 things on that. Number 1, there's a meaningful lower bound to ETH yields. Like we've modeled out what consensus layer, what execution layer rewards look like when there's 50, 60 million staked ETH. It's still high 2s, and like interest rates are high right now, but like those get cut, and it's also fundamentally different. It's an asset that has a chance of appreciation versus something that's supposed to be stable. Like you're self-selecting for different things. I'm also not that bearish on yields. I think they'll be higher even in the event that there's something like 60 or 70 million staked ETH, which honestly I do think that is probably the medium term base case, the next 3 years. In terms of like supplementing your staking yields with things like EigenLayer, I think it's true. I think there's going to be so many different flavors of EigenLayer. EigenLayer is just the first. It's not the last, not by a long shot. And the yield is dependent on what is the market cap of the Oracle or the DA layer or the bridge that you're securing, how much ETH is staked against it. But if you've got 60 or 70 million ETH staked, EigenLayer DA or whatever that inflation token that you're earning is, that needs to be a huge market cap. And that's a function of like, can Sriram attract the devs to build the things, and not just the primitives? Like he needs to build the use cases too. And so like it's a little bit more than just like build it and they will come. Like they each have to bootstrap a very real ecosystem. The other cool stuff that's going to happen in my mind is things like leverage staking, more of a marketplace for staking, people doing it for lower fees. Like I do think there's going to be fee compression on the validator side. So I think incremental yields are going to come from a lot of different places, but it's going to be more of like this multiplayer, multi-path game where it's like, you're staking your ETH on this Oracle today or restaking it, now you're doing it in, a bridge the next, and you're using stETH, or I guess another liquid staking token to do it. But it's long-term, it becomes more and more important if that amount of ETH staked for something like Lido to have dual governance, because you need to have some sort of coordination mechanism with the unstaked ETH, and honestly, the EF as well.
They've got the staking router too, so they're decentralizing their validator set.
Yeah, like
Lido.
The goal for Lido is not to like, just operate 28 node operators forever. Like they're adding new node operators every week, and DVT and the staking router is the path towards thousands. I do think, just like another brief, point on this is, in a lower price environment, it becomes harder for smaller validators to compete. They have less to pay their validators. They have less to pay themselves. And like you think of the thing that the EF just put in, which is that churn limit. Like I know what they're trying to do, but what that actually does is it just makes it.
Wait, Vance, can you explain that, the churn limit?
Yeah, they're basically slowing down the amount of validators that are allowed to enter the queue on a daily basis. And it should be, I think, the limit, I think we calculated it's like 50 or 60,000 ETH would be the max that you could stake. But what that does is it eliminates any chance for the smaller guys to catch up. Like it's good and bad. It's mostly bad. I think the long-term prognosis is that The smaller guys probably shut down or operate on something that can drive their cost lowers, like a DVT layer or the Lido staking router. But I don't think the days of like having 100 liquid staking providers are going to last very long, especially when most of them are sub 50K ETH staked.
I don't think liquid staking is a market structure which is naturally fragmented. It's a winner take all or winner take most market structure.
All money assets have this. Stable coins, major cryptos, they exist in two conditions. One is zero or the other is huge.
Regular currencies operate like this too. There's like 6 currencies that have any amount of liquidity. It's like the dollar, and then I don't know, probably be the euro or the yen or something like that. But yeah, it's a really long.
And the people who are in trouble are like the UK, where it's like you're kind of a big nation, but not really. We don't have enough economic momentum to support you. A lot of these LSTs are going to be in Britain mode, in my mind.
Someone made the point on one of the liquid it was the Solana, it was the Jito and Zave from Chorus One episodes. Someone made the point where, like, ironically, ETH staking ecosystem being so broken in the beginning led to the product market fit for liquid staking, because there was such a long withdrawal period in between when the beacon chain was launched and you could stake versus when you could withdraw. There was no in protocol delegation mechanism for stake, and there was actually like there was a big DeFi ecosystem, so there was a lot of opportunity cost for staking. So just like actually liquid staking originated in the cosmos but found product market fit first in Ethereum. And there is this sort of irony to even like ETH being very opinionated about not wanting to take big decisions inside the protocol and limiting the like throughput and usefulness of the main layer actually has led to this whole rise of really successful infrastructure providers around that who want to make it easier to use Ethereum. So like Lido would be an example of that. EigenLayer would be an example of that. Axiom, the coprocessor, would be an example of that. Like, it's sort of interesting. And some of these other protocols like Solana, which was like, hey, like we can actually just allow you to easily delegate stake within the protocol. Like the penetration of liquid staking in Solana is like nothing. The stake rate is like 75%, and the liquid staking penetration is like 3%. You know what I mean? I don't really know what to make of that observation, but now Ethereum is like, hey, some of these infrastructure providers that have risen up and found product market fit, we have no way to regulate or control them whatsoever. So now you're getting this whole narrative about, is Lido too powerful? Are they co-opting the network? And it's like, I actually hear them, but also this was the design choice that you made. What do you guys think about the?
If you could have withdrawn from the beacon chain, I don't think LSDs would really exist. Period.
I think they would still exist. Like, in this blog post, the guy is like claiming that we could not have foreseen this. It's like this concept existed on Cosmos before you transition to proof of stake, and the blockchain is built for tokenization. How is this like going to take a different path? Of course, people are going to do this. So I don't know. I sometimes it feels like people just like to bash on Lido because it's successful, and that's not really like the entire truth. Contributing to Lido is contributing to Ethereum, in my mind, at least. Their values align, dual governance. Like, I don't know how much more we need if they decentralize the validator set.
I think also you could make the argument, John Charb has made this argument, and I agree with it, that Lido actually decentralized the stake in Ethereum pretty effectively. Like, Lido just baked in these requirements about, hey, not all of the node operators, you can't just use AWS as your sole data warehouse. Or they also were like, hey, not all of the stake can be in the US. They made it geographically distributed. They kind of had this forcing function of all the stake flowed into Lido, and then Lido set these rules and pushed it out. Whereas if you had just allowed it to naturally accumulate, you saw this with Bitcoin, like all the mining just went to a relatively small region in China.
So all the stake would have gone to like to centralized exchanges, to Kraken, and to like, would you rather have it on Lido or would you rather have it on centralized exchanges? So that's where it would have gone.
Imagine them trying to fix that problem now.
Yeah.
That would be such a disaster. Like, you do have 180,000 people that own stETH, that have staked ETH to stETH. Like, this is a big community. I don't get why the disconnect persists, but it's not going to stop it from growing. I think the interesting long-term part of, I forget who wrote the churn limit article, But he's like, we're going to be at 75 million staked ETH by next year. That's way over optimistic. Like maybe we're at like 40 if it really picks up. But I think the interesting assumption that he had was that ETH would be at one point, bigger than the amount of unstaked ETH. And I can see why that would be a problem, but I still think the real risks are this restaking stuff. Like having ETH is one thing, having it baked into all these different slashing mechanisms, totally different.
There is more demand for yield bearing money than non-yield bearing money. Like there's Jack Farley did an episode with this guy, Sir Paul Tucker, who used to be a BOE, central banker for the Bank of England. And, we've talked about the debt on this show before. And like, from my perspective as an American, like a young American, I'm like, this is nuts. Why are we just accumulating more and more and more debt? But this, from the central banker's perspective, they're like, people want our interest bearing money. There is a market demand for non-interest bearing money and a market demand for interest bearing money. And the market demand for money that bears interest, which is treasuries that have a yield attached to it, is just higher. So if you kind of get into another frame of thinking about it, you're just serving the market what there's demand for. And why wouldn't you do that? It's cheap financing. So I kind of do see the argument that if you totally de-risked ETH, like let's just say in a totally hypothetical way, there was no risk of staking your ETH with Lido, like why would you have ETH that doesn't bear any yield versus ETH that does bear yield? You'd want the one that bears yield.
I mean, there's a balance, right? Why don't you just increase the inflation rate to 50%?
Right.
That's what you're seeing with like bonds today. Like, yeah, the yield's going up, but everyone's losing their shirt on the bonds that they already own. And it works until it doesn't. I think the goal of being like net zero or deflationary is aspirational, but really what you're trying to bootstrap is not. The fee side is a very meaningful part of the valuation of ETH, and I think you can get there based on fees that it does today, in terms of what it's worth today. But the far bigger market, the far bigger premium, the far bigger multiple is the money side. And making sure it doesn't lose whatever it is and it doesn't matter what exactly it is. I don't think it's like definable in one sentence or one word, but having everybody start with ETH as the gas token and having it be something that people want to have and restake and buy for the yield, that is definitely a positive step. But it just can't be 50% a year. But there is an argument that maybe it should be like an Eric Connor from the EF or former EF was making this argument. He's like, maybe it should be at 1 or 2% higher or 3% higher. I think that's a conversation that everyone will have at some point. And we're more likely to have it probably in the next year than in the next 2 years. I think yields will go back up and people will be like, we need to kind of, keep our foot on the gas in terms of like the deflationary side of it. But in bear markets, this is kind of always what happens.
You guys want to talk about some, you want to talk about Maker? Actually, Maker is having a little bit of a run right now. So we talked about it on, I can't remember, a couple weeks ago, maybe, where we went through this chart. Just here, I'll actually pull it back up because I thought it was a pretty interesting chart. It was just Maker fees versus TVL versus token price or market cap, maybe, which is somewhere here. But yeah, I mean, there are these two charts which are extremely correlated, which is the market cap of Maker and the TVL, which are both going down. But then if you look starting back in October of last year, it just started to rip upwards. And now, like last time we talked, the token price hadn't really started to move, but now it is kind of starting to move again. So obviously not financial advice here. And I'm more just wondering if this, we talked about a resurgence in sort of DeFi 1.0, and like you could put synthetics in this bucket, or I don't know, Uniswap or whoever you want, but is Kane, I went back, you and I interviewed Kane like a year ago, and he was really talking about TVL being a busted metric, or not a one size fits all metric rather. And fees were going to be the important thing. That's the single source of truth for actual real demand. So fees net of token issuance. So yeah, I'm just curious what you guys think, because they've also got their end game going on.
We're definitely agreeing with basically everything that you just said. I think Kane nailed it. He's probably a little bit early for everybody else to realize it, but So are a lot of his perspectives. I think what we're going to see with DeFi in the future of DeFi, whether it's 1.0, 1.5, 2.0 protocols that come back, is the ones that come back are going to be based around fundamentals where value is accruing. And Maker has shown that. I think we were looking at this recently. I think Maker's, so DAI is effectively the way that you measure this, right? And the DAI supply, I think, bottomed out near maybe a year ago, or maybe 11 or 10 months ago at 1 billion. And it's up quite a bit since then. I would imagine with Endgame, you're going to see a lot more activity. I know that there's been a couple of announcements this week on different sub-DAOs that are launching, specifically going after RWAs. I think you're going to see the model of Maker the central bank, with sub-DAOs being the commercial banks. And doing different things, taking on different risks, but being out there pushing the ball forward. So yeah, totally agree.
I think what you're seeing here is, for the last 5 or 6 years, there's always been a metric that people are that the market trades around, right? And there's always been games that people try to kind of play in crypto. So like, even if you go back to 2017, DeFi aside, right, the BitMEX leaderboard, like that was the game everyone was trying to play. Then it became, right, like Uniswap and TVL, and like the market kind of traded off this TVL narrative. And then there was like the game of NFTs and how high could you mint for and stuff like that. And now I think the market is moving towards fees as the game that people are playing, and that is the best game that we will have played yet, because fees actually drive sustainability.
Well, it can drive sustainability. It doesn't necessarily, and that
It's
I think
better than any of the other games at driving sustainability. I guess
Very
it's a
true.
step in the right direction.
True.
Yeah.
The only problem that I have with it is everybody's got a different definition of what actually is derived from that metric.
When the market does something like this, so like Maker is starting to, like, it feels like running a little bit. I had breakfast with a few like crypto funds and kind of big crypto traders. It sounded like Maker's like the most crowded trade in the room, at least like around the table. That was what people are saying. They're
Really?
like, yeah, people are like, Maker is starting to be the consensus crowded trade. When you see something like this, like from a trading perspective, does it make you think like, oh, okay, well, like one thing is running, like maybe the rest of the market starts running? You're like, oh, this is, I don't know. How do you think about that when there's like clearly one trade that
We don't think about it
into?
Making billions of dollars out of an investment like that. You don't do that by like looking for the to see if the 5-minute RSI is oversold. They're not always traded or crowded. The crowd kind of runs out the door at some point for some reason. And I think the other thing is that this is the only, or one of the only kind of protocols that benefits from higher for longer. And if you really believe that, which I think a lot of people are now kind of being cowed into, this is one way to express that without leaving crypto or without buying T-bills. Which, if you're a crypto fund, you're buying T-bills, I don't know what you're doing.
I will say though, if this was the most crowded trade in crypto, it would not be trading the way that it has been. It would be a wildly different experience.
Yeah, that's true.
There's a crowd that is Solana in 2021. All the billionaires are calling me about Solana. Like that is what a crowded trade looks like. So like I think about this thing of like, are you consensus or are you non-consensus? It kind of matters what level of perception you're on. If you're in crypto, like you're okay, sure, it might be consensus, but like if you're not fully in crypto, then you're still wildly. Most people don't even know what Maker is. Like,
yeah,
like most of the major funds have also recently sold this on chain. Like, define consensus for me, because I think we're still in the same perspective where it's like there's probably not a lot of sellers anymore, but there's certainly not a lot of buyers, certainly not of size. And, when something becomes crowded, you'll see, usually some indication of it ripping. I wouldn't call this ripping. This is like a little baby bump.
Yeah, that's true. What does that revenue say right there, Mike? What is the revenue number? 123?
Annualized.
That's low.
Annualized 123.
So this is a couple of disclosures. One, we own Maker. Two, if you look at all of the metrics on MakerBurn, I think MakerBurn is honestly the better site for this.
I think it's got more revenue. On MakerBurn, you're looking at like 170 or 180 in annual revenue.
Yeah. But even that doesn't capture everything, because, and this this is kind of one of the bear cases for Maker, is that it's definitely transparent and freewheeling. It's definitely a little bit like the data isn't quite up to date. Like
the data isn't quite up to date, or like the people who are running the treasuries forgot to put the money into the account.
Yeah, I mean, like they because they're going off chain to on chain in terms of buying treasuries. Like, there's meat space in the middle. There's people who need to do things, and
Yeah.
sometimes, like I think for a while they hadn't gotten a report from Coinbase on their P&L for like 3 or 4 months or something.
Yeah.
Take these seriously, but don't take them literally.
This is the Maker burn. So it looks like the annualized average revenue is around 100. I can't really see 160.
Yeah, I remember seeing 180 somewhere. And then the other thing was like 60 million in profit going back towards buybacks, right? And then you've got the DAI supply is growing. It's probably above 5 billion, maybe around 6 billion today. And then when you start to put the valuation on it, it's like, I don't know, you're getting like a PE of 20 and a revenue multiple of like 10 or 12.
Well, their largest cost item, the largest item on their expenses is DSR. And you would assume as soon as that, endgame phase 2 goes live, there's gonna be a lot of value that leaves DSR to go farm sub DAOs.
The other thing is that people, it feels like when this starts to happen, like this crowded trade idea, it's like people don't actually read all of the public information about what's going on. Like I ask people, like, do you know what the DSR is? Like, what is that? It's like, well, it's the main source of expenses for Maker. Like, do you understand how it works? It's like, no. The other thing is, and Rune has said this publicly.
Can you explain it, Vince?
Sorry, I'm just going to talk about the end game. End game is basically the process of, like, the commercial bank, the central bank model. Maker ossifies. Its job turns from collateral onboarding, ecosystem contributions, onboarding collaborators. They're just going to be giving DAI to these commercial banks. Spark to the RWA DAOs, there's 2 of them, and then to Sakura, which is kind of like this gamified yield aggregator thing targeted at Asia. But that launches in Q2. Like, it feels like people are really trying to front run that, and it's great that people are like re-energized, but it is going to take a little bit, like like it's September.
Can you explain why Rune thinks that's such a problem? Because I get that it's not unified. People think about them as 2 different things, but aren't they kind of 2 different things? They are 2 sort of different things, and both of them are good. I think both DAI and Maker have very close but super premium brands in crypto. What am I missing there? Why does it need to be one?
The public information out there is, I think he wants it to be like, the brand is X and then the stablecoin is XUSD. Not like actually X, it's just a placeholder. I think he feels strongly about that. Rune does.
So bringing them together. So DAI and Maker don't seem like they're under the same umbrella right now, but in the future it could be like Maker and then MKRUSD or something like that.
Yeah, he's talked about this where he says, I have people come up to me all the time and they're like, oh, well, what does Maker do? We create DAI. Oh, I love DAI. I use it all the time.
What's Maker?
Realize that
what does Blockworks do? What does Blockworks do? We were talking about this yesterday. Yeah, I empathize with that.
Love a good conference for people to let me know that they listen to our pods, but
don't know what Blockworks does.
But the other thing is the redenomination, which is probably the bigger impact. Is it 1 to 12,000, Michael, or 1 to 1,200?
1,200.
I think it's 1,200.
So new Maker will be $1, or like a little over $1 in that, formula. That is a really different community. Like, there's kind of no denying it. And if you slap a new name on it, it's like the meme of the guy with the tape and the water. I don't think there's a hole in Maker. I do think Rune does feel strongly about the branding, though. What it's going to be called, anybody's guess.
Are they doing a migration to the new governance token at the 1 to 1,200 ratio? That's just like a stock split. So that because people don't want to buy a $1,300 token, but they'll buy a $1 token, right?
I have no idea. Okay, the thing is
like, people don't want to buy a $1,000 share of Apple, but they'll ape into $150.
No, but it's important to upgrade the software.
Yeah.
It's important.
Get that tape
Yeah.
out. Slap it on there.
Slap it on.
It does make a difference, though. People do say Ethereum is $1,600. Can I buy half of one? Or I can't afford a whole one. It's like, oh god.
That's why you buy Litecoin. It's cheaper Bitcoin.
The poor man's
That-
life.
That is though such a real thing.
that
So many
narrative-
people think that.
Dude,
Like think that.
No,
way.
not anymore. But
does this all the time. I forget how many. Netflix did this too when I worked there. Like I can't even figure out what the price was when I started because the stock's been split like so many times.
Yeah. One time, it was probably around 2020 or something. Polkadot was exactly $10, and it was the fourth biggest crypto by market cap. And I bought some purely on the thesis that people would look at Bitcoin, think it was too expensive, ETH think it was too expensive, and be like, "Here's this one for $10." Like,
that's not the worst. That's not a horrible.
yeah,
thesis.
yeah.
So
Didn't do that well.
there's a lot of psychology into how you price IPOs, and the goal is to hit it, whatever the valuation is, to hit it around $20 a share, because the psychology is, do you want to buy a share of that company, or do you want to go out to lunch and buy lunch? And it's like, if it's something as simple as that, that's why all SPACs initially are priced at $10 to be a little bit less expensive.
Speaking of IPOs, do you remember when Bill Gurley, and maybe that'll be a segue into our last discussion point, but remember when Bill Gurley went on this rant about direct listings over IPOs?
Oh, yeah.
Yeah.
Probably.
I mean, he's not wrong.
Yeah, it is a weird process, but Matt Levine will write about this. There's like a nice aesthetic to like when the IPO goes live and then like the stock pops. I mean, it is kind of stupid. That's a really expensive like marketing strategy that you're running there, but it does. I don't know. I don't think it's totally valueless. Honestly, you don't want to pull an Instacart, right? And go public and have the stock fall out of the sky. That would suck.
Does that suck?
They're still above their IPO price.
Instacart didn't fall out of the sky though. That wasn't a horrendously bad.
Which
IPO.
one just did this
They
recently?
popped 2 days ago. So keep in mind, Mike, you want to price it. The company wants to price it at as high a level as possible because that's how much money they raise.
Yeah.
And the employees and the founders can't touch a single share until 6 months in. So it doesn't matter what happens.
I'm sure that's right, Michael. I think you try to underprice it a little to allow for a little bit of a pop, because as a company, you as a founder and stuff and employees, you can't sell it for 90 days. So you want to get that momentum going.
Totally. The three variables here are existing shareholders, the company itself, and then purchasers of the IPO. The purchasers of the IPO want a pop because they want to be able to flip it. And that's the whole Bill Gurley point. The company wants to maximize money raised because that's, it's a balance sheet question. And then employees have 6 months lockup. Founders have 6 month lockup. And yeah, sure, you want a little bit of a pop because it helps build the brand. And, what's this company doing? It just popped 20% on its IPO day, et cetera. But you don't want to pop, 100% because then you left money on the table.
You left a lot of money on it. Yeah.
Yeah, that's a good point.
I hear you. Yeah, I hear you.
That's a good point.
That's why it is sort of a marketing. It's kind of a marketing campaign.
Do you guys take a guess at Instacart's advertising revenue?
$500 million a year.
Michael cheated.
That's Uber's ad revenue. Actually, it's 500. Instacart, I think, is like 250 or 450. Some large number basically. And I think yeah, you know it. You know the number?
Not exactly, but it's around 500. It's about.
Uber's going to be at $1 billion in ad revenue next year. Amazon is $40 billion in ad revenue. Gets you thinking about super high value, like who uses Instacart, Uber. It's high net worth individuals. Oftentimes it's like people who, if you're in New York, maybe you'll take a $30 Uber instead of the subway. If you use Instacart, like you want it to get your groceries delivered. Makes you think about the ad business of Coinbase, right? I think Coinbase is like sitting on like a $500 million a year ad business, right? It's a bunch of high net worths, high intent demand side, large amounts of data on users. I don't know.
I actually disagree.
Yeah, I don't really love that either, to be honest.
I disagree. I think it's it would be very difficult for them to build Base and also suggest things to use Base for.
I
think there will be.
I would bet money they launch an ad network by the end of 2024.
But is it the highest ROI thing that they could do? I don't really think it is. Like,
no, there's a lot. There's lower hanging fruit. If they turn that futures exchange on, it's going to be just
somebody's going to own a colossal ad network in crypto, and nobody owns that right now.
So
right?
100% agree with that. 100% agree. Like advertising in the entire ad stack itself, what you previously had was you had closed systems. So, Google was an open ad system, Snap, Facebook, closed systems. Someone will build that stack based off of the decentralized, ecosystem, because all the data is available. It's how you marry that with proprietary targeting that will become very interesting. But it could be Coinbase, or Coinbase could be the data provider and just get paid, a services fee.
I feel like there's just more high ROI things that Coinbase could dedicate their time to. Like, I don't know. It's just.
Have you ever looked at Coinbase's product page?
Yeah,
there's a lot. There's a lot, but it's getting they are getting more concentrated. I think. Don't you think?
They don't think that way. This is Coinbase's product page. Look at all the freaking.
No, they do think that way. They think that way. I think they went too far in this last market, but like if you listen to their investor calls, they have like a 70-20-10 allocation framework, which is, I forget, it's not exactly that. It's some famous, I think Google came up with this.
It's the classic Google thing.
Right. It's like 70 core business, 20, sort of fringe, and 10% moonshots. And I mean, this is a lot
on that page.
That page is ridiculous. Yeah.
They could be focusing their time and effort on doing a stock split, which would give them many things. But chief among them, a new chart. I think getting back to that idea, a new chart, it's like a new day. It's anything is possible.
It's not a new chart. They just
look,
Apple and Google and all the other charts just go back and reset everything.
Sorry, they also need to rebrand. Pick a new ticker.
They should rebrand to Maker. Becomes.
We're gonna issue a second stock, and that stock is gonna be called Base.
AMC tried that. The pros are doing it. I think that's it.